Hey folks, this is Rajesh Patel from Acre Investments, and welcome to the June 7th video weekly review. AMRN President John Tharow gave a presentation at the Jefferies Global Healthcare Conference, and one of the new things that was revealed was that the company is preparing for an advisory committee meeting. Now, we told our premium service beta testers that we saw this as short-term bearish for the stock. It's bearish because it introduces another element of uncertainty and another gating decision before a potential approval for the anchor indication. So we see the stock did sell off and went down to the $6.60 level, and then there was a recovery on Friday. This is pretty much a mirror image of the kind of trade that happened last week, except this time we actually sold our position at $6.75. We were flat on the AMRN position. It was a very small position for us, and we have other trades that we're actively managing right now. So rather than being distracted by the AMRN news flow, we'll get back into it once we find another entry point, once the actual advisory committee date is set. So we think that this jump on Friday was actually momentum traders getting back in for two reasons. One is the perennial every month new chemical entity run up before the Orange Book comes out, and the other is because of the potential for an advisory committee meeting, and some people are just speculating that it's going to happen in August. It's not going to happen in August, most likely, folks, but that's what people may be thinking. Where is the stock overall, though? Let's take a broader picture of what's going on with AMRN, and we're going to look at the 3-year daily chart of AMRN, and we actually like where the stock is right now. We actually like the level that it's at. Take a look at this line here. This is the long-term support line. You see some support there. It was a resistance point there, and right now the stock has bounced off of this $6 level a couple of times. The last 2 weeks, the stock went down to $6.30, then went down to $6.60, and bounced both times back up over 7. We like to see that kind of action where it tests a bottom multiple times. That tells us that this is a true bottom and that the stock likely has consolidated and could go up from here. If it does start to go up because momentum traders keep piling into the stock, we see $8 as the first resistance point, $7.95 to $8, and that's this line here. And then, of course, the $9 level is the next resistance point. Now, if there is an advisory committee meeting scheduled, we could see a run-up ahead of that, and we could see it trade back up as the advisory committee date gets closer, back up to the level of this gap, because people will be expecting that if the vote goes their way, that they will get approved, and of course the anchor indication is 10 times as large. So the possibility of an advisory committee focuses the attention back on AMRN and back on AMRN as a run-up trade, as opposed to the focus that has been going on of are they going to get NCE or not, and how are the sales doing. So we'll be looking for an entry point, but we think that anywhere in this range, $8 to $6.50 is where it's going to go. If it breaks above $8, that's definitely a signal that there's some run-up trade going on, and it's worth watching or getting into. Of course, when the advisory committee meeting date is set, you're going to see the implied volatilities in the options go up. So if you're going to play this with options, try to figure out what dates you're comfortable with and find a position before those volatilities go way up. Let's look at ARNA Pharmaceuticals. This is the 1-year chart. And of course, the big news was that on Friday, Belviq finally was able to come to market just 3 weeks shy of a year after approval. So the DEA took pretty much 11 months to get its work done. Now that the drug is available, it'll be widely available come Tuesday, and Eisai has already started detailing doctors, and they plan to do 20,000 details within the first month. The big question is, what is the launch ramp going to look like, and is it going to be different from Qsymia? Of course, the bears say that there's no way that this drug is going to be successful, and they make basically an efficacy argument coupled with a lack of coverage argument. And I got to say that the pricing that Eisai has chosen does kind of work in the bears' favor. I don't understand how a more expensive drug is going to do better than a less expensive one. However, the bulls will say that the drug is differentiated and it's first in class, and therefore there's going to be a lot of people that want to try it. And there may be some merit to that. We'll see very quickly. If you connect the highs here, you see that you get a downward sloping line and the lows give you an upward sloping line. Those two are converging, and sometime in September is likely where that crossover would be. And that's pretty much when the first full quarter of sales data would be available. Now remember, the very early sales data in the first week to first month it's going to take a while for those numbers to get accurate, and so fixating on the very early numbers may not be such a great idea. But by September, we should have an idea of how this drug is doing and how is it comparing to how Qsymia was doing. And is this an insurance coverage problem? Is this a category problem? Or was it a Qsymia problem with their launch because of REMS or anything else? The other data point that we will have in between, though, is that Qsymia's retail program is rolling out in July, and so if they see an inflection in sales, that might read positive for ARNA as well. Here's a chart for Clovis Oncology. We see this huge jump on Monday morning. The stock moved up more than 100% after their presentation at ASCO. Several sell-side analysts increased their price target to the $73 range. Everybody got excited, and there was huge buying pressure. So from $35 all the way up to $86, and then you see some of those gains given back to the $59 level, and eventually the stock leveled out at around $71.90. Now keep in mind a few things here. First of all, there's only 26 million shares outstanding. That means that it doesn't take that many shares of net buying to send the stock up. It also doesn't take that many shares of selling to send the stock down. So this name is going to have a lot of volatility. And the other thing to keep in mind is that the data was very early data on a very small number of patients. However, the street seems to like the name right now, and that's why the stock shot up. We don't trade phase 1 results at Red Acre. There's just so many things that could go wrong between phase 1 and an NDA that we don't pay that much attention to it. And 9 times out of 10 for most of these smaller biotechs, the phase 1 data doesn't pan out. So we wait till phase 2 and phase 3, and therefore we don't feel bad about missing Clovis. However, if you're in the oncology space, you may want to pay attention to this because it is a name that was talked about a lot at ASCO this year. Let's turn our attention to BioDel. BioDel had some news this week. They added to their pipeline. They have acquired a glucagon rescue product, and they anticipate this is a phase 3 ready product that's going to go through a 505(b)(2) pathway. So they have to do a phase 3 trial, and then they anticipate by 2015 they'll be ready to submit an NDA. This means that the company essentially has 2 phase 3 ready assets if their clinical trial results for Bio 123 come out positive. We believe that there's a pretty good chance that those results will come out positive, which we'll cover at a later date. But you can see here the run-up. The stock already increased more than 100% and then has started to come down a little bit. The reason that it bounced off of the $5 level is something you can see if we look at the wider chart. So let's go to the 2-year chart here. Excuse me, whoop, we didn't quite catch the 2-year. There we go. The 2-year chart here, you see this $5 level as a resistance point, and that's where it bounced off of. You also see this lower point here, and this is where we expect the support to be. So right around the $4.20 range, right where it is now, is where support should be for BioDel. And keep in mind, this company has been through a lot over the last few years. They've had to do a reverse split. There's only 14 million shares outstanding now. But there's one key difference between BioDel in 2010 and now. In 2010, they had the previous CEO who was a little bit inexperienced, and they kind of screwed up their clinical trials of Linjeta by doing them in India, and then they had data issues, and they submitted anyway, and the FDA, of course, rejected them. This time around, they've got a much more experienced CEO. He has gone through and gotten drugs approved at several different companies, and now he has chosen to come to BioDel. He probably could have gone to a lot of different places, but he chose to come to BioDel. And we believe that they're doing their trials right, they're doing them with diligence. The clinical trial results that are coming up, it's a phase 2 result that is due in sometime in Q3, and as we said, we believe that those results are going to be positive. The drug is a rapid-acting insulin, ultra-rapid-acting subcutaneous insulin. So it's essentially competing with mankind's Afrezza, although it's still an injected drug. And this is a reformulated version of Linjeta, which is why we think it's fairly positive for the phase 2 results. One of Linjeta's big problems was that there were injection site reactions, a lot of pain caused by the citric acid that was used in Linjeta to keep the insulin hexamers from sticking back together. Now, they haven't gotten rid of the citric acid, but they've added other chemicals to mitigate that injection site reaction, and it appears to be working. So if the clinical trial results come out positive, you have a company with, right now at the $4 range, a $60 million market cap and 2 phase 3 ready assets. Take a clue from what just happened in the triglyceride market. You had a $1 billion company in the form of AMRN. You had a very tiny company in the form of Omthera. Which one got bought out? We're not speculating on buyouts here. However, we just think at a $60 million market cap, Biodel is nowhere near the top of its range. It should be trading much higher than this and come closer to the trial results. We expect this stock to continue to go up. And even if it goes up 200% from here, even if it goes up 100% from here, we don't think that the stock would be overvalued, and we don't think that the street would think the stock is overvalued, especially if those clinical trial results come out positive. Here's the 6-month chart for Elon, and this week the news was that Royalty Pharma once again increased their offer for a takeover of Elon up to a potential $8 billion transaction. Now, last week we told you that we didn't think $12.50 was the right price, but that if Elon increased their offer to $13 to $13.50, investors would do well to take that offer. Well, this week they increased the offer to $13, but the other interesting thing is they added contingent value rights, which are a potential deal sweetener. If Tysabri hits certain sales milestones, investors could get up to $2.50 of additional money, and that might be something that tilts investors in the favor of Royalty Pharma. We think that ultimately this deal happens with a price of $13.50, not even $13. So there may be another 50-cent upside from here. Keep in mind that there's an extraordinary general meeting of shareholders on June 17th. And if the shareholders approve the 4 different transactions that Elon management is proposing, then Royalty Pharma is going to walk away, and all of these gains that have happened in the last month are going to walk away with them. So, as we said last week, we think 13 to 13.50 is probably a good range, and the contingent value rights are just a little bit of a deal sweetener. And we think also that Elon's management, in these 4 transactions they're trying to cobble together in an effort to, within 30 to 60 days, spend $1 billion, is not necessarily acting in the best interest of shareholders. This is not the way that you do capital allocation of that size. So we don't think that long term the street is going to view Elon positively if this deal doesn't go through. That's just our opinion. We're on the sidelines. We have no position in Elon, but that's how we see it.
As with every trade, we encourage everybody to do their own due diligence. We remind you that we are not registered investment advisors, and this video is not specific investment advice for any individual that's listening to it. This is just how we see the trade, and you should use it for educational purposes. You can catch other Red Acre insights at www.redacre.com. You can follow us on Twitter @RedAcre. We'll be having further details of our soon-to-be-launched premium service, so if you haven't signed up for our email list, make sure you do so. And thanks for watching.